Welcome back to another Zero DTE video, and today Ernie's going to talk about risk to reward in a couple of different strategies. If you're interested in becoming a pro trader, check out the link in the description for a 4-week trial. And as always, enjoy guys.
Now, a 1-to-1 risk to reward is pretty good. What most people put on is a higher probability there. The probability of actually getting in profit here might only be maybe 55%, and that might not be enough for you. So what you'll do instead is something like this. You'll make that spread very high probability by putting it way deep in the money, and price will be right here. Because it has to travel a long way this way, there might be a 90% probability that you'll profit there. But now, look at the difference. Your risk curve looks like this now. Now, you have a long ways to go before you get to that break-even point. And maybe the chances are 90% that you won't get there. But now look at how big this risk is. Maybe it's 10 to 1. When you enter that trade, as soon as you start moving this way, you start going down. Even all the way to this point, it could go all the way down here, but you might be down $800, but you're still saying, well, if I hold on and it stays right here, then it will make the full $100 I'm looking for. Is that what you want to do? Risk 800 or even 1,000 to make that 100? Now, if it goes this way, obviously, or stays right there, you're good. You're golden. So while a 90% probability of profit has its appeal, the amount of risk that you take for the amount of reward that you get may not be appealing. And in fact, during the entire trade, on 50% of your trades, you're going to be in this red zone. See, we'll make it the red zone. So here's another strategy that you can use. Something where you can take two spreads, like the put and the call, or put or call, and put them together into what's called the butterfly. And it looks like this. So you could go and put on a butterfly, and it might look something like this. All right. Now the profit line looks like this at the beginning of the day when you first get in. Still has this problem. Now, on a normal butterfly, if you put it on in the beginning of the day at the money, it's going to range in terms of risk, but a typical one might be 3 to 1. I don't really have this to scale, but 3 times profit to 1. Often it is 5. If you put it on later in the day, it could be as much as 8 to 1 or something. But earlier in the day, and if volatility is very high, which it isn't these days, it's very low, this strategy also is going to give you an okay risk to reward, limited risk, and much larger potential profit. You have a nice wide area that you can go between, but it's really not that wide. I would say that your probability of profit here might be 60 or 65%, but you have the potential to make a lot of money for the risk. Now, one way that we can improve this, and this is the flexibility of the butterfly, is to put it out of the money. Let's say that you're sitting right here. This is the money. If you put it way out here and you put the center strike right here, your fly is going to look like this. Tiny little bit of risk and huge amount of profit, often 1 to 10. And then your profit curve will look like this in the beginning of the day. Now, at the end of the day, this profit curve can keep on growing until it looks like this, until it fills up what it looks like at expiration. So it really requires that, as a trader, you're going in the right direction, that it's going this way. But there's your risk. It's very tiny, and this profit curve is growing all the time. But here's the real key when you're getting into a trade these days. When you're in a very high volatility environment, when you start out with the trade, this profit curve that I have in cyan here is very flat, and it has a long ways to grow this way. But when you start out in today's environment, it's going to look a lot like this. Like it's going to be preloaded with a lot of profit. So as you move this way, earlier in the day, you have like a head start at what's going on. So this is a high volatility environment, whereas in a low volatility environment, it might look like this. So this has all kinds of implications about the width of the fly that you use, how far out of the money that you are, etc.
Thanks for watching guys. I hope you enjoyed the video, and if you did, make sure you hit that subscribe button and hit the like button below. If there's any questions that you might have for Coach Ernie, make sure you leave them in the comment section. Thanks guys.